Last week or the week before, I don't remember when, Federal Reserve had a 3/4, 75 basis points increase in the federal funds rate. And so my question is, after that happened, now that's like the fourth time in a row. I think one of them was not.
Third time in a row that it was 75 basis points.
And then one time it was 50 basis points. Yeah. Okay. So third time in a row, 75 basis points. What happened to mortgage rates after the federal government raised interest rates?
You know, that's a great question. Interestingly enough, this is the one rate increase that the market kind of digested and said, maybe this is the beginning of the end in terms of the Fed having to take big swings at tackling inflation.
Yep.
So the response was that we saw a lot of mortgage-backed securities and treasury yields start to improve. Actually drove rates down pretty significantly for mortgages. We're actually touching right where we were, or as low as we've been since mid-July.
Give me your thoughts about mortgage rates in the year 2023.
Oh, I wish I knew for sure. That would make me sleep better at night.
You don't have a crystal ball.
No crystal ball, but I can say just over my 20 plus years of experience of doing this, anytime we see as drastic of a change one way or the other as we have experienced this year, you almost certainly see a reversal that is almost just as dramatic. As soon as the Federal Reserve tackles the inflation problem, and we do see month after month, all the data tends to support that inflation is coming back down, which we're already starting to see those early signs, like we mentioned. Then mortgage rates are going to moderate and come back down more to what we're accustomed seeing, in the mid fives or so, maybe just the low sixes. But I would be surprised if we even saw high fours, because remember that with what the Federal Reserve is doing is they're cooling the economy, right? They've got to slam the brakes on the overall global economy. And in doing so, mortgage-backed securities and treasuries become a safe haven for money. People invest money in those because businesses aren't making the money that they used to make. And that'll drive interest rates down.
So I call my lender. My lender says, Cleve, it's going to cost you 6.375% to lock in on a mortgage rate today. I'm not saying that is the rate. I'm just saying the lender says that to me. I don't want to pay any more than 4.5 or 4.75 or something like that. What options do I have? How can I work around the system?
Yeah, there's basically three really popular options that we're selling in today's market. The most popular is to move away from 30-year fixed and into a hybrid arm. We've talked about this on the show before, where the interest rate might be fixed for 7 or 10 years, but that would afford you a 1.5 lower than a traditional fixed rate mortgage. Again, you're talking about saving $400+ a month in interest on the average loan that we do. So significant savings. Another option, if just the adjustable rates just maybe can't quite tolerate the risk that might go along with that, is to just pay extra funds at closing to buy down the interest rate. These are called discount points. You basically almost think of it as prepaying your interest by paying a higher closing cost, drive that interest rate down to where you need it to be for that monthly payment to be more palatable.
Do you think, John, the last couple of examples you've run of discount points, 1, 2, or 3 discount point, did it seem like a worthwhile investment of money? Meaning, could you get your money back in 3 or 4 or 5 years? You
bet. Okay. Especially with the first discount point, maybe the first 1.5 discount points. A lot of bang for your buck in the current climate for paying some discount points. So we're trying to retrain the consumer to say, hey, discount points are worth it. That's something we haven't talked about in a decade.